You're listening to the Financial Source podcast on YouTube.
Okay, let's get into it. If you're looking at the markets for the week of February 15th, 2026, it's a bit of a strange picture. You've got these warning lights flashing, but they're pointing in completely different directions.
It's a real tug of war. I mean,
Yeah.
on one side, you have pure economic gravity, interest rates, inflation.
The usual stuff.
The usual stuff, yeah. And on the other, you just have raw geopolitical force pulling everything in the opposite direction.
Exactly. So our mission for this deep dive is to try and decode that, figure out which side wins. We've got a major currency divergence, a really odd signal in the gold market, and this diplomatic tightrope walk in the Middle East that's, well, it's keeping oil traders up at night.
And the theme connecting all of it is just contradiction. Usually these markets all move together. Right now, they're breaking apart.
So let's start with the currencies. The AUD-JPY cross Australian dollar versus the Japanese yen. It's back up over the mid-108s. Feels like the Aussie is on pretty firm footing here. What's the story?
It's a tale of two central banks that are, well, they're living in completely different worlds right now.
Okay.
If you look at Japan, the data just isn't there to support that tightening narrative that everyone was expecting. Their Q4 2025 GDP, it came in at just 0.1% growth.
0.1%. That's barely a pulse.
It's basically flat. And it's seriously disappointed the forecasts. So with growth that week, it just cools all the speculation that the Bank of Japan is about to hike rates.
Right. And when the rate hike bets fade, the currency goes with them.
Precisely.
Yeah.
So the yen weakened. Now, on the other side of that trip,
You've got Australia, which is acting like the complete opposite. The RBA, Governor Bullock, they sound pretty hawkish.
that's the divergence.
Yeah.
While Japan is soft, the RBA keeps saying they're perfectly willing to raise rates again if inflation stays sticky. And you even had Assistant Governor Sarah Hunter flagging persistent inflation pressures.
And you've also got that background noise about hopes for a Chinese stimulus package.
Exactly. And because Australia is, a major supplier of raw materials to China,
If China stimulates, Australia gets paid. Simple as that.
so money flows out of the stagnant, low-yielding yen and into the Aussie dollar, which has a much better outlook. That's the math right there.
Okay, currency math makes sense. Let's pivot to something that often defies math. Gold. We saw XAUSD slip back below that big psychological number, $5,000.
It did, yeah, after a really sharp $150 rebound.
Which feels a little weird, doesn't it? I mean, with all this chaos, shouldn't people be flocking to gold as a safe haven? Why is it dropping?
Well, because on the surface, the economic data is actually supporting the U.S. dollar. And since gold is priced in dollars, a stronger dollar tends to push gold down. The general risk tone, believe it or not, is actually pretty positive.
But, and this is the interesting part, it hasn't crashed. It's just slipping. Something is holding it up.
The aircraft carriers.
That is a very literal safety net.
It is. We are heading into another round of U.S.-Iran nuclear talks. But you have to look at the hardware in the water. The U.S. has just moved a second aircraft carrier into the region.
And Iranian officials are already warning about retaliation.
Right. So even if the economic data says sell gold, that whole geopolitical backdrop puts a structural, a safety bid right underneath the market.
It's like an insurance policy.
Exactly. You don't cancel your fire insurance just because you see smoke coming from next door.
Speaking of smoke, let's talk oil. WTI crude is stuck below $63 a barrel. For a region with two aircraft carriers floating around, that feels surprisingly cheap.
It's range-bound because the market is completely paralyzed. It's trying to price in two opposite futures at the exact same time.
Okay, so on one hand, military buildup.
And on the other, you have the political signals. U.S. President Donald Trump just said a deal could be reached within a month.
And Iran has signaled they're open to a deal if they get some economic relief. So the diplomats are saying peace, but the navies are saying get ready.
Perfect summary. And the referee for all of this, it's the Federal Reserve. It always comes back to U.S. interest rates.
And we just got the latest CPI data. Headline inflation up 0.2%, core up 0.3%.
Which is firm, but it's not a disaster. It was soft enough that the market is still holding on to hope for a Fed rate cut in June.
So everyone's just waiting for Wednesday's FOMC minutes.
That's the key.
All right.
If the minutes confirm that we're on a path to a rate cut, the dollar weakens, and that helps both oil and gold. If they don't,
Volatility spikes.
you got it.
So to recap this whole balancing act, we've got the RBA and the BOJ in a tug of war. We have gold fighting the dollar, but supported by geopolitical fear. And then there's oil, just stuck, waiting for a headline.
That's the landscape.
Eh.
And here's the final thought to leave you with. Right now, today, the markets are pricing in a diplomatic solution within 30 days. That's why oil is below $63.
But with a second aircraft carrier just arriving in the region.
Right. What happens to that risk premium and to the price of oil if those talks stall for even a single day?
That's a heavy question. Keep your eyes on the headlines. Thanks for listening to this deep dive.